Okay, so we got Suhail Ali Hassani, who's investment manager for the Al Ghurair Group. Nicholas Roper Khan, who presented earlier, Chief Investment Officer and Head of Wealth at the Family Office. James Walker, Managing Director at the Jaw Family Office. And also Eric Cass, who's joining us from Florida, manages a major RIA down there. So let's go. Actually, in all the printing that I did, I actually forgot to print these questions out, so I'm going to read them from my phone. Welcome, guys. Last session. Let's try and make it entertaining. All jokes allowed. Okay, let's set the scene first, right? The family offices here out in the region are different to the family offices that you may know from other parts of the world, like Duquesne Family Office or something like that. So maybe we can start, if each of you can just outline your sort of area, the objectives of your family office, benchmarks, capital, asset allocation, balance between capital preservation and growth, and how much is devoted to liquid listed assets, which is what we're focused on here, as opposed to other assets. You're free reign. You can talk about how your fund works.
Can you guys hear me? Okay, good. So just a quick introduction. My name is Suhail Ali Hassan, been in the region for the last 12 years, and this is my third family office I work here, so I have quite an experience with that, and especially with the family office scene here. So for us, the family office is more of a wealth preservation vehicle because the family made most of the money in the region here, so they want to allocate a bucket just to diversify, and it's a high ROI here, so it's more of a wealth preservation vehicle. And our mandate is 7 to 8% return, very stable, especially investing outside of the region here, US and Europe, more of developed markets. And we're currently setting up that the family office, and the idea is to be an endowment-like family office, 60% more or less in liquid markets, that's public equity, hedge funds, and fixed income, and 40% in alternative across all sector. And just to talk a bit about the landscape of family office here. So at the end of the day, we're more asset allocators, right? So we're not taking single stock bet. There is some family office doing that, but mostly 80–90% of the family office here in the region are asset allocators. So we want to find top managers and we'll allocate to them. So for us, this is we see it more of a macro environment. So are we risk on, risk off? Should we go more tactical? Which asset class should we move? So most of us are like this, rather than diving really deep into single stocks and identifying breakouts and all of that. So for us, technical at Rabdis and technical analysis is more from a macro point of view, seeing which asset classes are changing on a long-term basis, rather than following it on a daily or weekly basis.
Great. Nick, you want to go next?
So I spoke earlier, so I'm sure everyone's
you've bored. Outlined it already.
Pretty bored by now, but
Sorry for missing.
we're the polar opposite and exactly the same as Suhail's family office. We are all about wealth preservation. Most of the money comes in from a corporate side. It's about diversification. It's about trying new sectors, but pretty much the core of it is let's get 7 to 8%. That's what we've been told is possible. We all know that's a lot more. And let's just move away from the business. So for us, there's a lot of money in media, oil, energy, a bit in financial services. So we try and stay away from that. But the benchmark, I think, for most of us is starting to become, as we become more professional, is Yale and Harvard as an endowment model. That's that's where we'd like to be. We're almost like pension funds. We're liability driven. This money is for family. This money has objectives. This money has to be drawn down. So it's a mix of capital. It's a mix of income. And, luckily, depending on the chief investment officer, families are willing to go into different sectors. If they're comfortable and the chief investment officer has the skills, like the CMT, then they're willing to do things. But yeah, pretty much Yale, Harvard, diversifying away from the corporate holdings.
James?
Thank you. Yep. So my name is James Walker. I'm MD of Jaw Family Office. I've been based here for 5 years, originally from London, if you can't tell by the accent. As a family, I'm a Gen 2 family member. My late father had an operating business in the UK, diversified into real estate. That kind of continued on in terms of acting as a custodian of those assets. We're still around 60% real estate, which obviously provides quite a lot of illiquidity. Over the years, we've started to sell some of those assets and create more liquidity. Historically, those assets have been managed on a discretionary basis by external, expensive, underperforming asset managers. We are now trying to become more institutional, if you will, in the way that we manage those assets. So the last few years has been doing rather, I wouldn't say boring, I find it interesting, but effectively it's about building the right foundations to build on for the next 20, 30, 40 years, making sure that we have the right building blocks. So making sure we have our assets with the right custodians, making sure that we've got our fee base as low as possible, and then basically looking to recreate those portfolios using products which have high liquidity, low fees, and so we're capturing the beta of the market as cheap as possible, and then we can look to try to capture alpha by conducting various tilts. And so when it comes to knowing when to raise cash, that is something which, as a family office, certainly from a discretionary perspective, most discretionary managers don't see cash as an asset class a lot of the time. Obviously, it's always important to have some from an emergency perspective and things of that nature, but there are times when it makes sense to take money off the table and move to cash, and that wasn't really a concept that the managers we've been using actually had. So what I'm now trying to do, along with an external CIO who has regional experience and also experience away from the Western Hemisphere. And my view is that we are in a changing world order, and I think it's important to make sure that when we're constructing portfolios, we're looking out 5, 10, 15 years in advance and saying, from an asset allocation perspective, do we want to have all our eggs in one basket? Do we want to be, allocated to the dollar? Do we want to have a lot of US equity exposure? Or do we need to start hedging dollar? Do we need to start buying more gold? Things of that nature. And I think having an external CIO who has experience in the region is going to be helpful to make sure we're set up for the next 10 or 15 years. So that's a process we're going through. And TA is something that I'm looking to use and have been using. And I'm in the process of formalizing the process in terms of how we will use it, both of going risk on, risk off, leaning into certain industry groups and certain asset classes.
Eric?
Great. So I guess in the spirit of Malcolm Gladwell, I would describe the RA that we currently have now as somewhat of an outlier, right? We're not really categorically anything. And it all started, I think the genesis, I started in this business in '97 as a CFP, a financial planner. And I think that gave me a unique opportunity, which at the time I was shrouded in this cloak of disadvantage, I thought, of elevating how we deliver investment advice to our clients, right? So a lot of us know, we've hinted at it in here, that a lot of our industry has this inertia around modern portfolio theory, a lot of these wives' tales, I call them. And there's a reason, right? If you're a financial advisor, your job is to gather assets, not to waste time on allocating them. So hey, shotgun approach, that's defensible. So as our business began to grow, I was looking for a better way, right? And so obviously CFA, I think the CMT has been the most important thing I've ever done. And so I've spent the last 20 years crafting the mosaic, if you will, of how do we deliver institutional level advice to our wealth clients, the network of advisors we have, and distribute portfolios at the same time. And the key to that was, and it's been alluded to earlier here, simplicity, I believe, is the ultimate form of sophistication. So a lot of times we like to complicate things to make ourselves sound super smart. But at the end of the day, when I was able to take data that we all use and turn it into narrative, but not narrative that we're used to, narrative that lands with the client. And I use a lot of colors. Green is good, red is bad. I use smiley faces, all kinds of stuff. Because remember, we're talking in a room here. I have advisors that are here, and the end client is here, right? So how do we get the message across? And that's basically what I've spent the last 20 years evangelizing. And that becomes I believe, simpatico with the family office, right? Large RIAs that are very forward-thinking, I think are tangential to what these gentlemen are doing here in the family office space.
Okay, great. Now everyone's set the stage. Let's go into technical analysis specifically. That's what we're all here for. Where, why, and how do you apply technical analysis in your family investment process? Was it a challenge to introduce technical analysis? And where does TA add the most value? Is it timing entries, exits, risk management, or helping remove emotion from decision? Or is it more relative strength type stuff? Or maybe, James, we can go to you first, because I know that we've had extensive conversations on relative strength and how to potentially apply this. So maybe we can start there.
Yeah, so I think making sure that you apply technical analysis is actually more down to kind of routines and the discipline around those routines. So from our perspective, I have a kind of a dashboard or a cockpit, if you will, that I like to look through usually every day. I don't need to look through it every day, but I tend to do it, and I tend to start kind of at the high level with bond yields and bond spreads, and then looking at the currencies. And then, as in the main currency pairs, and then looking down at the main asset classes. And when I say main asset classes, I'm referring to, someone mentioned before about the all seasons portfolio, all weather portfolio. So looking at, you have ETFs, which are effectively proxies. So you have GSG for commodities, you have GLD for gold, you have IEF for kind of mid-term, belly of the curve, US Treasuries, TLT long, SPY, UUP for dollar. And you're basically looking at these main asset classes and seeing where is the money rotating. And it's at that level where I think most family offices can derive the highest value, because it's on turning points where the most money is made. And it's also when long-term trends change is when you really need to start paying attention. And also when correlations break as well. So, with gold specifically, there has been, as was mentioned, I think, couple of days ago, about correlations breaking. So it's at that high level where a lot of family offices are making asset allocation decisions. So that's looking at the asset allocation side, and then it's drilling down into kind of S&P sectors, looking at countries. So someone mentioned Poland before. So there's some fantastic MSCI country indexes, about 25, 30 different countries that you can look at. And then you have relative strength charts. And just to be clear, a lot of those charts I'm mentioning in terms of currency strengths and asset allocations, a lot of those are against the SPY, right? So one wants to do better than the SPY and see where money's rotating away from that. And so there's many other things I look at. They're the main ones, things like breadth, and so understanding where money's flowing within the actual within the market. Alongside the dashboard, what I have been doing is trying to come up with a set of alerts which are simple enough, but not perfect. So I think it's very easy to try to set an alert which is absolutely perfect and is reliable 100% of the time. But actually, I think the trick is to, first of all, not set too many alerts. So ideally, for these major asset classes, it's trend up, trend down, and those are enough to basically make sure that you're looking and focusing your attention on those areas. And ideally, these alerts are set to only really trigger when something major happens. So these are not alerts going on and off every day. It's using time frames like Nick's likes the 2 week, the 1 week, the monthlies, and just spending the time initially at some point to set these alerts and say, I don't know when this alert's going to go off, but when it goes off, I know something's going to happen, and then we're going to pay more attention. So the alerts are level one. We then have, as I say, the daily routines of checking the charts. And then there's another set of alerts, which is a little bit more noisier, which is more on the kind of the sector type basis and breadth indicators, things like that. So that's kind of the kind of suite of alerts and dashboards that we tend to use. And it certainly has informed our tilts that we've taken and our positioning that we've taken over the last 18 months.
Okay. Nick, if we can just go to you next. Your approach is completely technical. How did you convince your family that this was the correct approach to take, or were they already on board before you took this approach?
Yeah, I don't tell them.
Okay. You let the results speak for themselves.
Exactly. it's the whole process of running a family office is half of it is education. Educating yourself, learning something, educating the other family members. So I keep it simple. We are long-term investors. It's all about what's your time frame. We are long-term investors. What are the things we're worried about? We're worried about noise, making mistakes during noise. So sell the news or don't sell the news. Just navigating through the global financial crisis, the dot-com bubble, 2022. So I keep it really, really simple. We are long-term investors. If the market looks like it's rolling over, we will just trim. We'll just stop allocating to those risk assets. Risk on, risk off. Very simple. Okay. So I just approach it as when things look risky and dangerous, which is when everything looks amazing. Right? Everything's amazing. We've just made 400% in altcoin. You de-risk. Really simple. So just slow and steady.
Eric, if I can go to you, you've got a lot of advisors underneath you, right? And some of them must be using charts, etc. Do you let your advisors take trades for clients based just on the chart? Or have you got any examples where you've taken a big allocation, changed the allocation across your portfolios or across client assets based on a purely technical factor?
Yeah, so full disclosure, I am on the CMT board, so take this all with a grain of salt, but fundamental is, to me, table stakes. The technicals it permeates every layer of my investment process, and it starts top down, and that's what's distributed through my network. And what I mean by that is I'm in the spirit of keeping it simple, right? We start with a foundation of relative strength, and I have 6 blocks that I show my advisors at any given time. And those are the basic building blocks of a portfolio. And what I'm trying to do every day is discern the interrelationship of supply and demand in between those asset classes and rank them. Green is good, red is bad, right? So US international commodities have been the top 3 asset classes for the last couple of years, right? And so we start there in the framework. And then as you move down the layer, and we've spoken about here, we can go country specific or region, et cetera. We keep peeling the layers of where we want to go. And then you tie that back to then each particular advisor and their end client, right? So they all have a different risk appetite. So I seldom think in terms of 60-40, 70-30. I think if this client has X risk appetite, and these are the 3 asset classes that are more supportive of higher prices, I'm going to focus there and either have nothing or opportunistically short the other asset classes. And so I evangelize that in the portfolios I run internally, and then I let that out into the network. And so what we'll see is advisors joining the network want to offload, right? They understand that they're not the best at managing capital. They're the best at managing relationships. And so we'll tend to handle most of that for them. But they're allowed to do their own thing, rep as PM and choose their own, within some parameters. But yeah, I will take larger positions. That's the beauty of being unconstrained, right? I can express an opinion and I can take a 40% position in something, right? And I don't have to be constrained by 5% max position weight or, I have 70% cash in 2007. We're open mandate. And so it gives us a lot more flexibility. But yes, technicals drives everything.
Wow, because you can go to cash if you needed to.
Oh, absolutely. And it depends on the strategy. So that's layer 1. So I'm running all tactical models, even our, full equity models there's nothing saying I can't have hedge, cash, et cetera. And then that also then translates to the advisor to the client level. Maybe this client's a little bit more risk averse, maybe in the family office category, and all right, they may have more cash or more gold or whatever it may be. But yeah, we're very open kimono about where we can go.
Okay. So Sahel, your office is probably the most conservative, but you've got a lot of liquid equity positions as well. Is there a point where technical analysis becomes more of your process? Have you broached this with them, or how do you see this progressing?
Okay, so look, as a CIO, you need to have a macro view, a bit understand what's happening out there, and to be able to communicate to your principals and have a view, right? So I write a weekly newsletter to my principals, and with that, technical analysis helps. So I use that in my newsletter. But you need to remember that we are asset allocators. So we're already allocating to asset manager, GPs across all sectors. So my view is to make sure where are we on the risk parameter, right? Are we risk on, risk off, and be able to communicate with those asset manager and at least discuss the views that they have. Maybe I have a different one, so we can find the middle point and invest in that idea. And
Always risk on.
and TA helps a lot in that way. So for me, my strategy is, I try to look out of the noises. I really don't follow the news as much, the public news out there, like either it's like Bloomberg or FT. I have a few subscription that I really like, and those guys make their money out of the subscription, right? If their calls aren't good, they will be out of the business soon. So I like to have some independent views. And other than that, it's purely TA, and it could be macro as well. So following, inflation, unemployment through charts, and the big, sectors, gold, Bitcoin, all of that, which will help me, have a view on all asset classes and where we are in the market. And usually, those don't change over time. Which market regime you're in. It takes time for big changes, right? So yeah, it just keeps me on track and to filter all the noise out there.
Right, so using it to help your communication to your principals.
Definitely. It helped me as well have a but more confidence in my view when I say, okay, we're still risk on right now in the market. So, yeah.
Okay. Let's go on to this area, this tension between fundamental research and technical analysis, which has been a topic here. Family offices, and I imagine a lot of our RIAs are probably inundated with research from the sell side inviting you to events, pushing funds onto you, pushing investments onto you, etc. And sometimes this can be overwhelming. Then you have your own work and what the price action is telling you. How do you balance this all out? How do you filter the information from the sell side, from your advisors? Is there a huge quality difference in your advisors? And do you stick to a few specific advisors? I think, Sohail, you might have answered this.
Yeah.
Or do you canvass the entire market for the best ideas? I don't know, Eric, you probably see the most stuff. I don't know if you want to start.
Yeah, that's a great question. I mean, so our investment process is multidisciplinary, right? I believe in the synergy between the fundamental and the technical and really the behavioral, right? So it's all crafted into the mosaic that we put together in terms of where we think the landscape of the market is and where we want to be. And the beauty of being top down, which, and this is, I believe, supported by a lot of empirical research, is that positioning is the most important thing, right? And when you go back to some simple studies, we know that 50% of the market or a stock return can be attributed to the market, the next 30 to the sector. So you got 80% market sector, 20% on the stuff you see on TV all the time. You're inundated with new product or earnings release. And so this area is so well covered by the CFA community. I believe that's commoditized. So we focus on understanding which markets and sectors we want to be in. That's most of the battle. And then at that point, where that decision tree walks us, then it's about market efficiency. So if it says I need to be large cap blend, where we've had to be for the last 14 years, I'm probably not going to waste money, not disparagingly, but on an asset manager. We know they don't outperform over 5 or 10, so I'm going to buy the spider in the queue. But if the decision tree walks me down to inefficient asset classes, fixed income, emerging markets, small caps, areas that it's clear that the index is in the bottom decile, we could add value there. Then I'll look to individual ETFs. Maybe I'll bring in a manager, especially something that complements, like I don't do fixed income. So I'll bring in individual bond managers to the ecosystem. And so that's kind of how I fill out the allocation. It's kind of the church of what's happening now and what do I need. And at that given point in time, you can just work that, basically the relative strength diagram all the way down to the individual stock or manager level.
Okay. James, if you can just focus on a specific area of this, how do you filter the information that's coming into you, all the brokers, all the sell side? How are you filtering this? How are you managing this?
Straight into the bin. Most of the time. I mean, I think that the issue is that, we have historically used discretionary managers in private banks, and the fact of the matter is they underperform 95% of the time. And so it's actually useful to keep having these reports, because you can say, well, look, they made this call here, but hang on, we were telling the IC about this 5 or 6 weeks ago. And actually, it's quite useful to have our own, internal benchmarks, but also use these house view, publications to compare. Now, there are certainly some banks out there that do actually use TA, okay, and actually they're the ones that are actually, we believe, worth paying more attention to. But a lot of the time, if there's no evidence that they're using TA to inform their view, then you get into the same situation where, you're reading the FT and it's telling you that gold's up near 4,000, and you're like, well, hang on, we were buying at 1,700, and it's by the time it's got into a house view of a private bank, by the time it's gone into the FT, by the time it's on CNBC, it's not a sign to sell, but it's certainly a sign that you're incredibly late. And TA is all about making sure that you are getting an early alert to changes in sentiment, changes in asset allocation. There are certainly certain resource houses which do publish great research from a macro side, Ned Davis research, people like that, and they're worth certainly subscribing to. However, it's very easy to get inundated with this sort of stuff. So even that, it's almost something that you look at after you've done your own research. It's a bit like when you wake up in the morning and you got the opportunity to look at the Financial Times, look at CNBC. But if you follow your Daniel Kahneman, thinking fast, thinking slow, this concept of priming, you don't want to start reading the newspaper and the FT first thing in the morning. You should be doing looking at your graphs, looking and forming your own opinion, and then perhaps look at Ned Davis research, FT, all this sort of stuff. So psychology is incredibly important, and sometimes these reports create the wrong psychology.
Yeah, this was one of my observations working on the sell side as well, was that the research analysts, there's a big difference between understanding a company and understanding a market. And research analysts often understand companies really well, so you can actually utilize them to really give you a deep understanding of the company. But by the time they've upgraded a stock, it's already up 150%. I used to coach with the research analysts working with me that you need to upgrade something on the inflection. That's how you make your name, right? Like some of the charts I put up earlier. You upgrade it there, you're a superstar, but you've got to find the bull case at that point.
I'll just add something, because I think someone mentioned, Stanley Druckenmiller says, invest, then investigate. And so the idea of having the ability to screen and find stocks which are starting to move up, buying a small position, so you're psychologically and ego anchored, if you will, to the stock, and that then motivates you to do the fundamental research. And some of the time, as long as you've got a process to do that, you then find out the analyst has upgraded the stock next month, right?
Yeah,
so
that's exactly right. Stanley Druckenmiller doesn't talk about it so much, but if you read his early interviews, right, it's there that he is basically, in my view, still using the chart. But when you look at his 13 Fs, you say, right, where do I reckon he bought this, right? It's usually a good chart. You never see a bad chart in Stanley
after it broke out of the base.
Yeah, no, it's shocking how much I think he still uses this. And if there is not a bigger proponent for TA, the fact that Stanley Druckenmiller uses TA, I don't think you need any more than that. Okay, if you can just go on to a slide.
I would just like to defend banks a little bit, because often they only have 200 or 300 analysts. So it's very hard for them to come up with an opinion.
Say again?
They only have 200 or 300 analysts, so it's quite
true.
hard.
That's true. Yeah.
And are there any banks that stick out to you that use TA?
I would say, I think there's a bank we have had discussions with, CIS Bank, which have, through their research, through their social on LinkedIn, etc., it's very clear that they have a strong TA team. Now, in terms of kind of portfolio returns, I can't specifically speak, but the fact that they have a process around it, I think demonstrates that they're open to having TA influence their process and asset allocation.
Yeah. Seems like this creeping in more and more, right? And people are looking at the benefits of it. We
You
just
need
go
to find the CIO that have a CMT.
but by the way,
and
size
in
is
one
the
of
only-
those banks, the CIO or that have a CMT. And
Yeah,
the
well,
background,
I
there
was
is some of
told
them.
something really interesting during when I was working for UBS, and I'm not going to mention the name of the fund, but there was a very big sovereign wealth manager and someone that knew the CIO, and they said to me, do you know how he invests? He uses the 50-day moving average. That is how he invests the entire sovereign wealth fund, right? And I was like shocked, but I think it was a pretty high percentage. It was true.
And guess what size bank has a CMT on their investment committee? Surprise, surprise.
All right, I'm just going to another area, right? Maybe Sahel, we can start with you on this one, right? Because I know that you have a big interest in new technologies, digital assets,
Personally.
AI, all of these new areas,
Yeah.
right? Now, are you trying to influence your family to step into these new areas? And how are those conversations going? How much education is needed? And, how is that process?
Eventually. So at the beginning, we still don't hold any S&P 500, right? So the family has been so conservative. All the money has been made here in the region, the UAE. And recently, with the death of the patriarch, second generation coming in, they decided to set up a family office just to diversify maybe around 10% of their portfolio elsewhere. So we didn't even hold any S&P. So we're going to start with the basics, having some bond portfolio, S&P, some NASDAQ, through asset managers, and as well in the private market. But eventually, definitely we want to have part of the portfolio, maybe, it could be up to 5% in digital assets, crypto, and other technology, Even VC might take a bit of time, but it all depends on the CIO of the family office, right? Like how involved he is. And the thing is just in this region, the funny thing is like most of the CIOs hold in their personal portfolio cryptocurrencies, right? But their family office have zero allocation. So especially the younger CIOs, so they all hold crypto. But it has been a hard discussion to the principals, especially if they are more traditional and made their money from traditional businesses here. They don't want to take that risk. And again, the family office objective is wealth preservation. So why take that risk? But there's some interesting strategies right now in digital assets, which is like Bitcoin yield and DeFi yield, which it's emerging, and it's a conversation to have with the principal, and at least it is a start, because this goes in the bucket of hedge funds, right? So it doesn't need to be a crypto bucket, because we think in buckets, right? So any asset class we need to invest in, okay, where does it fit? So this one could easily go in a market neutral, hedge fund bucket, and most of the family office here have that allocation. So I think this is a good start of the discussion to happen with the principal, and at least the initial investment. It's less volatile and it could be easily digested. And I've seen, not in my current family office, but in other similar family office, the discussion is being made. There's a lot of education and conferences where even CIO are taking their principal too, and discuss those.
Have any of you guys seen a generational change in your family office leadership, and has that led to a change in the investment strategy? You guys seen that yet?
Well, he is generational.
Well, actually, this is probably most applicable to you, James.
So when
You
you say
are the change in
so when you
the-
so when you say generational change, I mean, I think it's fair to say that people who are kind of Gen X or millennials have a different access to securities than boomers did, right? So if you are with private banks, etc., who are charging high fees, who are underperforming, and then you've been using Robinhood or Trading 212, Interactive, all the different kind of brokerage firms, you're a little bit more of an informed buyer, if you will, and it's likely that the next gen family members are going to be more informed and want to take more interest in how their money, of which they're then responsible for, is being managed and invested. And obviously not everyone is going to take an interest in it, right? And I think it's very down to the family and obviously the culture within the family. But I think those who are interested, I think, depending on their disposition, are likely to be more willing to get their hands dirty and get involved in managing the capital if allowed to do that, but within the right guardrails. And so my involvement in the family office, it's still done in a manner which has clear guardrails, because there's still a fiduciary responsibility to manage the capital. And so when we are looking to introduce TA, it is done within a framework of process and systemization, and it is something which has been pre-agreed with the trustees, for example, in the same way that you would if you were appointing an external asset manager. So there's a very clear investment management agreement, there's very clear processes around it, investment committee, etc. And you have to be able to demonstrate that you can actually outperform, otherwise the trustees are not being fiduciarily responsible. So I think from a generational perspective, I think that pretty much illustrates the difference perhaps between if we're having this conversation 30 years ago.
Okay. Eric, so you must have seen, you obviously have a lot of portfolios under management, right? Have you seen where a portfolio has basically passed from someone maybe who's died onto the younger generation? And has that younger generation person literally turned the strategy on its head or wanted to take more risk, less risk? What have you kind of seen? And are a lot of these kids, this must be trust funds for some of these kids, are they very actively involved or not involved at all? They just want their income from it and leave it up to you? Give us a flavor.
It's I would say hard to paint with a broad brush, but I've noticed a bifurcation in
Even give some specific
adoption,
examples, yeah.
Even amongst advisors and clients of the younger generation is much more adaptable to these new technologies or the concepts of investing in digital currencies, and they also view them as much less risky, right or wrong. Whereas the older generation, even if they are begrudgingly entering the space, still the devil you don't know, they're really hesitant to enter the space. And so I think where we get the biggest disconnect is when there has not been enough intergenerational work done in, say, the family office or the investment policy. You're not bringing in the second and third layer early enough to the conversation to where they've been excluded and the one person's managing everything. And then when that happens, it's just complete chaos. It may be with you, it may not, it's a turnover. But when they're involved in the plan early enough, they maybe understand the thinking of how things were put in place, and there still might be some adjustments, but I think there's more of a congruency in the handoff.
You ever had a situation where a pool of assets had been handed over to a younger family member, and he's had an older RIA, and the guy's basically said, I don't want this guy managing this pool of money. He doesn't know what I want.
You're fired.
Sorry? Yeah. Do younger family members want younger IRAs, or is it the other way around? They actually want more experienced guys?
That's a great question. Again, I think it really depends on the preparation, the seasoning that was done ahead of time. If there's a relationship there, they tend to stick. And also, if it was being done correctly, Like, so, well, a lot of times there'll be a fresh set of eyes on the portfolio, and they'll go, oh, wow, why do you have a $50 million account and you're in mutual funds, like incredibly tax inefficient, et cetera. So they're much savvier to, especially with the access of information, to what a portfolio should look like, as opposed to some portfolios I've seen that are pretty tragic. At the size I see them, I'm like, wow, this is very parochial. Like, how does this happen? So it's a combination. Were they involved, and was it a good portfolio in the first place? They're much more aggressive about moving if it wasn't.
Okay. All right. Does anyone want to make any closing comments or advice or predictions on how this goes forward in terms of family offices, technical analysis, investing in new areas? Does anyone make any predictions or observations so we can close on? Is there any thoughts or comments?
I think the space is becoming more professional, more sophisticated. And I think as we get more noise, and we have a lot of noise, advisors, CIOs will have to have the CMT, will have to have that data, even if you're reading the book and not doing the exams. I think we all need a way of just removing this negative, and we're all in groups, right? We're all in the same group, right? We've been through it.
Still far away from that, if compared to our peers, right? Like few of us We're all CFA type of,
And us, we can see the wood for the trees. Like,
yeah.
just the Trump dump. All I did, open up a chart, look at the last Trump dump. It was October, November, December 18. Guess what the drawdown was? Same percent as this time. Like, pretty much the same percent on S&P and the Qs.
I think
And
it
I
would
just
give us
sat there and just was like, okay, guys, we've been here before. We were expecting it a year later. It's happened now. Let's deal with it. What's it going to happen? What's going to happen? It's a V-shaped recovery. Same thing's happening. Bang. And we were back in fully risk on the 14th of April.
Wow.
And it's a
fully.
contrarian indicator
And
as well.
that's just simple data analytics, TA, chart analysis, Trump doing Trump over and over again. So to answer your question, I believe everybody will just capitulate and say, okay, I need to learn this because I can't listen to these wonderful journalists who we employ a lot, their opinions anymore.
I'll jump on my soapbox for a minute here, because I think there's a tremendous opportunity for everybody in this room, because I'm still in the advisory space, and I still see the massive amount of inertia for people clinging to things like modern portfolio. And I like to say, great, it's defensible, there was Nobel Prizes, but 70 years ago, lobotomies were standard practice in medicine, right? Bravo to the healthcare system for advancing. Our industry is still very sluggish. And so for those of us that are willing to evangelize about the value of technicals and the combination, there's just a lot of blue ocean. And I think the family offices think in that same regard, right? They're not thinking about how to sell, what to sell. They're thinking about how do I do the right thing with this pool of money by the client. And that is much more on par with what some of the larger RAs are trying to do. We're client first, not product first or commission based. And so I just think we're in like the early innings of what should be a big tectonic shift in who people look to invest their capital. And I think it's this kind of environment that's going to be the beneficiary.
I think I'll add to that. One of Nick's slides was talking about what a bit like you can't time the market, you can time the market, things of these kind of myths, right? And I think everyone likes a good chart, and I think CMT or charting, when you talk to people about that, they think day trading, they think speculation, and they don't really understand. They don't know what a weekly chart is, what a monthly chart is, what a ratio chart is, what a strength chart. They have no idea. And I think there are certain providers, private banks, etc., which are starting to use charts as a way of proving that there is value in this information, visualizing some of this stuff. And I think that the challenge that family offices have, especially trustees who are fiduciaries, etc., is that unless they take a personal interest in this sort of stuff, it's easier for them to say, just put it there. It's it's very much like mutual funds. They tend to performance tends to cluster because if you have a different view, then you risk getting fired. So it's a bit of you have to almost approach it from two lenses. The providers who want to differentiate themselves probably need to be a bit more proactive around demonstrating that CMT and technical analysis is not just about day trading, not just about candle patterns and all this sort of stuff, and show where it can help tilt and shape and achieve outsized returns. And I think the individuals who are consuming those services perhaps need to start asking their providers to explain, hang on, I saw this chart on LinkedIn or et cetera, why are these guys making this call and you were late and this sort of stuff. So I think it does require, it's kind of a two-pronged approach to try to change the perception and branding of the value that charting can bring.
Can I dovetail on that? Because what's so important about the people in this room getting out and spreading the word is we are now combating the weekend technician, right? I think they call it Dunning-Kruger, right? The peak of Mount Stupid. You know just a little bit about technicals, and then you put it out on Twitter and you're wrong. And then people who see that go, oh, these guys don't know what they're talking about. So separating, the wheat from the chaff here, like we really know what we're talking about, this really works, versus the, Monday morning quarterback who just finally figured out what a head and shoulders pattern was, right? And how many of inverse head and shoulders have I seen at tops of charts, right?
What's that?
Those don't exist, do they? Right?
Right, fantastic. And I say, how do you want to add anything, or should we close the session?
Good, I think everything was said.
Yeah, I think we'll let everyone go. We'll give the floor back to Tyler. Can we please have a round of applause for our panel? And thanks very much, everybody.
Any question? You have one from the audience? Any questions right out here?
Where's the beers?
It's a rare occurrence to have such a beautiful panel,
Earn it,
right?
Nick.
5 handsome guys all in one spot. There you go.
I've seen that.
Fantastic discussion, guys. We spoke about how you tune out the noise from outside, from the fund managers, etc. How do you tune out the noise from inside, from the family?
Was that from the family?
Yeah.
Yeah, so from inside, like one member wants to do something,
Yeah.
somebody else wants you to look at something else.
Yes.
Like your efforts, your
That's the toughest job of family office, actually. I'd say it's 80% dealing with the shareholders and 20% investment, right? Because end of the day, you're allocating, so it's like just dealing with them, and each one has, and especially explaining to them, right? Like, because they hear something from the news, right? Like inflation, or like the big headlines, right? Like,
Right. You get the WhatsApp with.
yeah. So you need to, as well, you cannot tell them, you're just wrong, right? So you need to agree with them and maybe explain to them a little bit, and lots of education. I think it's important. So bringing them managers probably that aligns, so they don't only want to hear your view, they want to hear it as well from other people. So bring them education and educating them through the macro. So mainly they are concerned on the macro stuff because this is what they read in the news. So yeah, interest rates coming up, unemployment is going up, Trump this, Trump that, which is basically all noise, right? So we're in a risk-on market regime right now, just be long only, right? So so you need just to guide them through that, and but yeah, it's a lot of talking, but yeah, it's management of characters and management of people.
So I'll add to that. If you preempt them, use base pump, use base dump. Do you want to be the sucker? And like we said, V bottoms are happening over and over again until they don't, right? But it's just education, education, education. The same thing happened. So I remember I got a call. There was a crypto bank, SVK, SVR, SVB, crashed, and I got, what are you doing to protect my, well, I just bought some Bitcoin. What do you think I'm doing? It's just educating, saying, look, we're in an uptrend. It's just, and that was scary because we'd just come out of 2022. It's literally just educate, and just expect this thing. And even if we're wrong and there's a bounce, there's always a spring, right? Wyckoff says there's a spring. Yeah.
I'll add something to that. I would say it is education. It's also about never talking in absolutes. So talking on a probability basis helps ensure that your ego is never attached to your views. Because if you're saying, well, I was 60% sure about this, then you've still got wiggle room to say, well, I said 60%, I didn't say 100. And I think it is important when you're trying to, even yourself, to keep your ability to change your position, it's best to think and talk in probabilities. And when you're trying to build credibility with an investment committee and other family members, you can still make calls. I mean, it doesn't mean that those calls are implemented, but if you said, well, that guy said, six months ago that the TLT was going to dump because the Fed was putting rates up, and show that there's ways of building a track record which don't necessarily mean actually running hot money, right? And if you do that over a sufficient time, you can start to gain credibility, and you're given a small pot to manage, etc., and you kind of grow your credibility in the same way that you would if you were building running a hedge fund or something of that nature. And we're in an industry where your returns speak for how correct or not you were, right? There is no subjectivity to that.
Just adding to that, that's one of the reasons I don't like targets. I've got no idea. And the minute you put a target on something, you're doomed. You're just absolute bias to that target.
Easier to find bottoms than to find.
It is, but
Yeah.
again, you're just like, okay, there's the pattern, there's the price, it's telling me. But you don't know where it's going. So
Fantastic. One more round of applause for our panel.
Thank you, Chad.